A lot of retirees think Medicare premium is just one fixed number, but for high income retirees, Medicare can cost a lot more, sometimes a lot more. And the reason is something called an IRMAA. That stands for Income Related Monthly Adjustment Amount. In simple terms, it's like extra Medicare premium that uh, you have to pay because your income went above certain levels. And what surprises a lot of retirees is this: the income that triggers that IRMAA may come from like 2 years earlier. So in this video, I'm going to explain what an IRMAA is, why Medicare premiums rise, what income counts, how Roth conversions and RMDs are accidentally triggered, and how you think about playing around this. Just a quick reminder before we begin, this video is for educational and informational purposes only. This is not financial advice. Anytime you're dealing with investing or options, make sure you do your own research and make your own decisions. So, IRMAA stands for Income Related Monthly Adjustment Amount, which I just went over. So it's just the amount that some higher income Medicare beneficiaries pay. It can apply to Medicare Part B and Medicare Part D. So Part B is the medical insurance side, doctors, outpatient care, things like that. Part D is the prescription drug coverage. So IRMAA is not a separate tax bill that shows up by itself. It's an income-based adjustment that gets added to your Medicare premium. Now, the important thing to understand is that IRMAA is based on income, not health. So, two people can use Medicare the same way, but if one person's income is higher, that person's going to pay more for the Medicare because of IRMAA. That's why the retirement income planning matters. So, Medicare premiums can rise because Medicare users' income tiers. For most people, there's a standard premium. But if your income crosses a certain level, you may move into a higher premium tier. That doesn't mean you did anything wrong. It just means that Medicare sees you as a higher income beneficiary. And once that happens, your Part B and D premiums can rise. This is why IRMAA feel like hidden retirement costs. It's not always obvious when you create income that you might do a Roth conversion, you might do a large capital gain, or you might have a big RMD year, and later that income can show up in your Medicare premium calculations. So that planning point is simple. Our IRMAA is about income threshold, not medical use. This is the part that catches a lot of people off guard. Medicare premiums are often based on income prior to from the prior tax return. That creates what people commonly call a 2-year look back. For example, your income in year one may affect Medicare premiums in a later year. So a big income year today can create a Medicare premium surprise down the road. This matters because retirees often make large income decisions without realizing the delayed effect. That Roth conversion this year may affect future Medicare premiums next year. A large capital gain this year may affect future premiums next year. Or a big RMD may affect future premiums. That timing is key. The income year and the Medicare premium year are not always the same. So with IRMAA, you just stop asking yourself, or you got to ask yourself, how much income did I create? You're also asking, when will Medicare see that income? So what counts towards IRMAA's income? The key number is generally your modified adjusted gross income. It's often called MAGI, MAGI. For IRMAA, MAGI generally includes adjusted gross income plus tax exempt interest. So what can show up under that number? Your wages or your business income, pensions, IRA withdrawals, RMDs, Roth conversions, capital gains, tax exempted interest, other taxable income sources. So that's why IRMAA planning is really income planning. It's not just Medicare planning. This is a very important point. Qualified Roth withdrawals generally do not increase Maggie. That is one of the reasons why Roth accounts can be useful in retirement planning, but Roth conversions are different. A Roth conversion can increase income in the year that you make the conversion. So Roth withdrawals, Roth conversions, they're not the same thing. That distinction matters. All right, now let's talk about retirement moves that can accidentally trigger IRMAA. The surprise usually comes from one big income year. That large Roth conversion can do it. A big RMD year can do it. Selling appreciated stock can do it. Large capital gains can do it. Business or income or rental income can do it. High interest dividend year. The point is, it's not that these things are bad. Of course, you're making money, but a Roth conversion can be smart. Selling an investment can be smart. Ticking income can be smart. But if you do these things without thinking about Medicare and income thresholds, you might be surprised later. So the IRMAA planning is not about avoiding your income. It's really about understanding the timing of your income. So Roth conversions are one of the biggest reasons people need to understand IRMAA. A Roth conversion can be very useful retirement planning tool. You move money from a traditional pre-tax retirement account into a Roth account. You pay tax now, and if the rules are followed, qualified Roth withdrawals later can be tax-free. But here's the big issue. The conversion generally adds taxable income the year that you do it. And that year added income can increase your income Medicare sees. So Roth conversions can be smart for long-term tax standpoint. There's no question about that. But it can still create a short-term Medicare premium issue. That does not automatically mean you should avoid Roth conversions. It means the amount and timing matter. A small conversion spread over multiple years may be better than a large conversion in a single year. The teaching point is this: evaluate Roth conversions with both taxes and Medicare premiums in mind. RMDs can also create IRMAA issue. RMD stands for Required Minimum Distribution. Once that rule applies, you may be required to withdraw money from certain retirement accounts whether you need the income or not. And that income can stack on top of everything else: your Social Security, pension, interest, dividends, capital gains, other income. And then your RMD lands on top of that. And if that combined income is high enough, Medicare sees you as a high income beneficiary, that could potentially trigger IRA or IRMAA. That's why planning before RMD's age can help. If you wait until RMDs are already forcing income out of you, you may lose flexibility. You have a little bit less. But if you plan earlier, you may be able to manage that tax bucket a little bit more intentionally. So how do you plan around IRMAA? First, estimate your Maggie early. Don't wait until after the year is over to think about your income. Second, review your current IRMAA threshold for filing status. Sorry, that's kind of tough to say sometimes. IRMAA. Third, spread large incomes when possible. Right? That might mean avoiding unnecessary stacking of bonuses or lump sums or Roth conversions, your RMDs, capital gains, all in the same year. Fourth, coordinate Roth conversions carefully. Fifth, manage large gains intentionally. And sixth, if income drops because of a qualifying life-changing event, ask whether an IRMAA appeal may apply. The goal is not to be afraid of income. The goal is to understand how your income affects Medicare premiums, your taxes, and your overall retirement plan. Don't let tax tail wag the retirement dog. Plan the whole picture. There are times when somebody might be able to request a new IRMAA decision. This usually involves a qualifying life-changing event that caused income to go down. So examples can be like marriage, divorce, or annulment, death of a spouse, work stoppage or reduction, loss, you lose your pension income, or you lose some income producing property, or whatever, The form commonly used for this is called the SSA-44, but this is important. An appeal is not automatic. And you don't just do it because you don't like the premium. The issue is whether your income changed because of a qualifying life-changing event. If so, your income dropped meaningful and your IRMAA is based on older income year, it may be worth asking Social Security whether you qualify for reconsideration. So here's the practical income investing takeaway. IRMAA is income based. The 2-year look back matters. RMDs and Roth conversions can trigger it, capital gains can trigger it, and planning early can help prevent surprises. But the goal is not to avoid income. Income's good, but that is the mistake. The goal is to control when income shows up. Sometimes you may be able to make sense to do a Roth conversion at a certain time, or sometimes it may still make sense to sell the investment that you have. Sometimes it might make sense to take that income that you deserve or that you're working for, but you don't want to understand the full cost before you do it. That includes taxes, that includes Medicare premiums, that includes how today's income is going to affect the future year. If this helped you understand IRMAA more clearly, please consider subscribing for more practical income investing retirement education. And if there's another retirement topic you want me to cover, leave it in the comments. Thanks for watching. I'll see you in the next video.